You spent 30 years learning how to put money into retirement accounts. Nobody teaches the other half, how to take it out. And that half is where the tax bill actually gets decided. Withdraw in the wrong order, or from the wrong account, or a year too early, and you can hand the IRS thousands of dollars you never needed to pay. Here is how withdrawals work in 2026, and the strategies that make them cost less. Before any strategy makes sense, you need the map. Your retirement money sits in 3 buckets, and each one is taxed differently. Tax-deferred accounts, traditional IRAs and 401 kiloseconds, are fully taxable on the way out, and they eventually force distributions. Roth accounts come out tax-free and, in the case of a Roth IRA, never force you to take anything. Taxable brokerage accounts tax only the gain, often at 0 or 15%. Almost every decision comes down to one question: which bucket, and in which year? Retirement withdrawal rules are driven almost entirely by your age on the date of the distribution. 59.5 is the big one. That is when the 10% early withdrawal penalty disappears. 73 is when required minimum distributions begin, and that moves to 75 if you were born in 1960 or later. 3 others matter. The rule of 55 lets you tap your most recent employer's plan penalty-free if you separate at 55 or older. Qualified charitable distributions open at 70.5, and Section 72(t) payments avoid the penalty at any age. If you need money before 59.5, there are legitimate ways to get it. The rule of 55 works if you separate from service at 55 or later, but only from that employer's plan, not an old one, and not from an IRA. Section 72(t) payments work at any age, though you are locked in for 5 years or until 59.5. Roth IRA contributions can always come out. And remember what the penalty is not. Avoiding the 10% does not make the withdrawal tax-free. $40,000 at a 22% rate still costs $8,800 in income tax. Eventually the IRS stops asking and starts requiring. A required minimum distribution is an amount you must withdraw each year from tax-deferred accounts, whether you need the money or not. It begins the year you turn 73, or 75 if you were born in 1960 or later. 3 things to know. Your first RMD can be deferred to April 1st of the following year, but then you take 2 in 1 year, often a bracket buster. Missing one costs 25% of the shortfall, 10% if corrected promptly. And if you are still working and not a 5% owner, your current employer's plan can often wait. The calculation itself is simple. Take your account balance on December 31st of the prior year and divide it by a life expectancy factor from the IRS Uniform Lifetime Table. That factor shrinks a little each year, so the required percentage climbs as you get older. One distinction trips people up constantly. Traditional IRAs can be aggregated. Calculate each one, then take the whole total from any single IRA. Employer plans cannot. Each 401k must pay its own required distribution from its own account. Your custodian usually calculates the number, but the liability is yours. Put numbers on it. A retiree turns 73 this year holding $800,000 in a traditional IRA as of last December 31st. The uniform lifetime factor at 73 is 26.5. 800,000 divided by 26.5 is $30,189 that must come out. Skip it entirely and the penalty is 25%, $7,500. And notice what that distribution does. It is ordinary income stacked on top of Social Security and everything else. Defer the first one to April 1st and you take 2 in a single calendar year. About $60,000 on one return. The conventional advice is a sequence. Spend taxable accounts first, tax-deferred second, Roth last. The logic is sound. Capital gains rates are lower than ordinary income rates, and Roth dollars should compound as long as possible. But followed rigidly, this order has a flaw. It leaves your traditional IRA untouched and growing for a decade, and then hands you an enormous required distribution at 73, right when Social Security has also started. The best sequence usually blends the buckets rather than emptying them one at a time. Here is the same portfolio managed 2 ways. In the first, withdrawals are blended, some taxable, some tax-deferred every year, deliberately filling a low bracket. The IRA balance stays moderate, so the required distribution at 73 is manageable. In the second, the retiree spends only taxable accounts for years, enjoying very low income, while the IRA compounds untouched. Then 73 arrives, RMDs land on top of Social Security, and the bracket jumps. Two effects make that worse. Up to 85% of your Social Security becomes taxable as income rises, and Medicare premiums step up at fixed income cliffs. So what do you actually do about it? The gap years, between your last paycheck and the start of Social Security and required distributions, are the most valuable planning years you will ever have, because your taxable income may never be this low again. Map that window. Then fill your bracket on purpose, converting traditional IRA dollars to Roth up to the top of your current bracket and no further. After 70.5, give directly from the IRA with a qualified charitable distribution. It satisfies your RMD and never enters your income at all. And coordinate Social Security timing, because delaying widens the whole window. Let's line the two account types up at withdrawal time. Traditional dollars come out as ordinary income. Roth dollars come out tax-free. Traditional accounts force distributions at 73 or 75. A Roth IRA never does during your lifetime. Traditional withdrawals raise the taxable share of your Social Security and count toward the Medicare premium thresholds. Roth withdrawals do neither, which is why they are such a useful release valve in a high-income year. And for heirs, both generally must be emptied within 10 years, but one arrives as taxable income and the other arrives tax-free. So where do you fit? If you are retiring before 59.5, your job is building a bridge, taxable accounts, the rule of 55, or 72, payments to get you there without penalties. If you are retired but not yet 73, you are in the gap years, and your job is converting deliberately while your bracket is low. And if you are already taking required distributions, your job is controlling what you still can. Satisfy the RMD. Use qualified charitable distributions if you give anyway, and time extra withdrawals around the Medicare thresholds. This is not one decision, it is a different decision each decade. 5 mistakes that cost retirees real money. 1. Cashing out a 401k at a job change, tax, penalty, and decades of lost compounding to solve a short-term problem. 2. Forgetting an old employer's plan, because each one owes its own required distribution. 3. Taking an RMD from the wrong account, since IRAs aggregate and employer plans do not. 4. Writing the charity a personal check instead of using a qualified charitable distribution. The direct transfer never enters your income at all. And 5. Ignoring withholding until April, which turns a planned withdrawal into an underpayment penalty. 4 dates to mark. Roth conversions and qualified charitable distributions only count for the year in which they are completed, so the window closes December 31st. That same date is the deadline for every required distribution after your first one, with no extension available. April 1, 2027 applies only to a first RMD, if you turn 73 during 2026. And taking it then means 2 distributions land in 1 year. Finally, January 15th is the last estimated tax payment covering the prior year's withdrawals, though withholding directly from the distribution is usually cleaner. The bottom line. First, which account you withdraw from matters as much as how much you withdraw. The same $50,000 can be fully taxable, partly taxable, or entirely tax-free depending only on its source. Second, the gap years are the whole opportunity. Between retiring and required distributions, you control your bracket. After 73, the IRS controls a large part of it for you. Third, plan the year, not the withdrawal. Decide your full year income target first, then take distributions to fit it. Withdrawals are not an event. They are a 30-year sequence, and the order is the strategy. If you are not sure what your withdrawal order should be, that is a conversation worth having before year-end rather than at filing time. At Shore Financial and Tax Services, we project your required distributions, model Roth conversions across your gap years, and set an annual income target you can actually follow. Call us at 900-8955-0696, email contact@suryapadia.com, or visit suryapadia.com. If this was useful, subscribe for more practical tax planning. This is general education, not individualized advice. Talk to a professional about your own facts.